In this particular video, I would like to discuss accounting for long-term notes payable and in particular mortgages. So mortgages usually require to make installment payments that will consist of two parts. One part is interest, and then the other part is actually a reduction of loan principal. So, for example, we've got a company that issues a 500,000, 8%, 20-year mortgage, and the terms provide for annual installment payments of 50,000 roughly, not including real estate taxes and insurance. Let's take a look. Usually a company will set up the following schedule to make it easier for them to keep track of all the journal entries. So for example, on December, I put 21st. I meant to say 31st on all of these. We borrowed our $500,000 mortgage, and you can see that all the payments will remain the same during the 4 years that we need to actually take care of this mortgage and make the payments. To calculate the interest expense, we will apply the same formula like you've learned in chapter 3. You will take outstanding principal amount multiplied by interest rate, 8% in this case, per period. In this case, it's per year. And then you will be multiplying it by the period, the time. In this case, it will be 1. So, for example, 500,000 times 8% times 1 for 1 year will equal 40,000. Then that means out of this $50,926 that we're paying, 40,000 is attributed to interest, and the rest is the reduction in principal. So roughly $11,000 will go against the principal reduction. How would we know what's the outstanding balance as of the end of the year? You will take the 500,000, subtract the reduction, and then here's the new balance. Okay, what about next year? Next year, the interest expense will be slightly lower. Why? Because your outstanding balance is now $489,074. So take that, multiply by 8%, and multiply by 1, so roughly 39,000. So reduction in principal is higher. So as the mortgage payment progresses, your interest expense is actually reduced, and then the amount applied to the principal reduction is going up. So we went from 10,000 to 13,000. So as a result, in 4 years, roughly 450,000 out of the loan is left. Look at the journal entries that you will be making. So yes, I did put them all on the 21st of December. I meant to say 31st of December. So for the first year when we borrowed, the journal entry will be very much the same as you did for notes payable or bonds payable. We debited cash for 500,000 and we credited the mortgage payable. Then in a year, we will need to make the first cash payment of 50,926. So we credited cash. And then the amount of interest expense is 40,000. So for the year 2021, on the income statement, we will show 40,000 worth of interest expense. And then a debit to mortgage payable of $10,926. The next journal entry will be very much alike, except the interest in mortgage payable will change. So cash is the only one that will remain the same. Okay? And you will continue on with the journal entry. Now, one question that you might be asking yourself, how will I show this mortgage on the balance sheet? All right. So, for example, as of December 31st, 2020, we know that your overall total liability, so if we're talking as of this date, December 31st, 2020, we know that we owe this much, but you will have to split it between the amount due that you will pay within a year. You will pay 50,926, but not all of it will be a reduction in liability, because you know 40,000 is expense and only 10,926 will be a reduction in the liability, so liability due. Therefore, as of 12/31/20, this is a portion of current liability, okay? Or this is your current liability as of this balance sheet date. And then the remaining balance, 489.74, is long-term debt or long-term liability. So again, overall total is 500,000, but it's split between the two portions. This amortization schedule also helps for the next year. So if the balance sheet date is December 31st, 21, the liability that will be marked as current will be 11,800. So that's your current liability. And long-term debt is 477,274. Long-term debt. What if the problem did not ask you to set up the full schedule? You can still come up with the calculation if you were to look at the journal entries, and somehow it kind of squished together. So we'll see what's going on here. I provided you with the journal entries, and I provided you with the balance sheet as of 2020. So here's the date. Looking at the journal entry for next year, we will be paying off 10,926. That's why it is presented as a current liability. How would you know how much is long-term? Well, total outstanding borrowed amount is 500,000. So take your 500,000, subtract what's current. The remaining balance will be long-term debt. And I actually put one more year, okay? So this is 2021, so it's a little bit more cumbersome. So for that one, if you look at the journal entries, I'm looking for the year 22. Why 22? Because anything up to December 31st, 22 that is due is current liability. So this will be paid in 2022. This is due in 2022. That's why it's your current liability. Now, what about the long-term portion? Take what you borrowed. I'm going to subtract the first amount that we paid in 2021. It's this one. And then I am going to subtract also the amount of current liability that will be shown in the balance sheet. We already did right here. So the remaining balance that will show up as long-term liability is 477,274. Okay, and here's just a basic representation of balance sheet. If you have other liabilities, for long-term liabilities, bonds payable due in 2025. So this is, they're probably hinting maybe 12, 31, 20 or so. So it's way past the 1 year in advance. Then look at that, less discount on bond payable or plus premium. And this 920,000 is called carrying value of the bond. Sorry, I lost it. Carrying value of the bond, carrying on the books. Mortgage payable at 11%, due in 2031. Here is the amount. And then lease liability at 440,000. So total liabilities is over $1 million. And this is showing exactly what I just explained in the other two PowerPoint slides.